Today was a somewhat strange day for markets. We've been saying that there was good earnings data. We were happy about how earnings were looking. However, we got negative GDP data today. That was a shock. I did not see that. I don't think a lot of people saw that. I think a lot of people were fearful about a recession in the future, and very, very few were forecasting a domestic recession now, that we could possibly be in the midst of that. While technically we haven't met the definition of a recession, which is 2 consecutive quarters of declining GDP, so we would need to see April, May, and June also be negative, it's kind of a surprise. However, stocks rallied today, and there's a pretty clear reason why they rallied. A big part of the reason why the market's been down since November, or various parts of the market have been down since November, and some parts, like the 10x growth stocks, have been down since January of last year, is the notion that the Fed is going to raise rates and tighten the money supply. Therefore, it makes sense to hold savings, bonds become more attractive investments, the demand for dollars goes up. We're all seeing these types of things play out. And when bonds become more attractive investments, they return more over the long run, and that hurts tech stocks. However, with GDP declining, and unexpectedly so, one has to question, can the Fed really increase interest rates? Because, like we said, that increases borrowing, increases saving, decreases borrowing, and increased saving means decreased spending, exacerbating any sort of recession. So it's possible that when the Fed speaks next week, they say, hey, negative GDP, we want to tighten, we want to get inflation under control, but we want to make sure we can do so with the soft landing. And they can't say they're going to have a soft landing if GDP is contracting and they're being hawkish. It doesn't work. So that is bullish for stocks, being that the rising of rates, the hawkish Fed, was the primary driver of things. However, what I was most anticipating today was Apple's earnings, and the earnings look good. I'm actually happy. I'm actually happy with the fact that people are buying so many iPhones, so many Macs, etc. Still, after COVID, after they had possibly, maybe they've got the upgrade, they're not going to do it anymore. They did it last year. Why would they do it again? Doesn't seem to be the case. So, strong Apple, which, yes, an iPhone is a necessary good, but an iPhone upgrade is not necessary at all times. So, the fact that people are still purchasing what we'll call it, not necessary goods, at least not, an upgrade. An iPhone is necessary. I would definitely categorize a phone as a necessary good. But if the economy is going to be tight, if GDP is really going to be negative in a scary way, I would not expect Apple to make $50 billion in iPhone sales in a single quarter, especially when international is weak. And I heard something about China. I'm going to listen to the earnings call and, really get what we care about, the supply, the factories. Will they have stuff on the shelves? These kinds of things. That's what we want to know. So we'll have that tomorrow. We'll see what happens. Overall, I'm liking things today. How am I positioned? Well, positioned the same. Got lots of energy exposure. Because of the negative GDP, I took my bond shorts down, my 20-year treasury shorts down a little bit. But not all the way. I still expect the Fed to tighten. I still expect rates to go up a little bit. But the total, forecast I had for that is now decreased because negative GDP. I don't think the Fed can really push the hawkishness all the way out. So I think that is going to happen. And I can't have such high exposure to shorting bond yields if that's the case. So realize some gains there. We have tremendous gains there. Took that off the table a little bit, still remaining in that position. Then, big mining and materials companies added to Intel today, added to Disney a lot today. and I've added, periodically to companies like Editas, Smile Direct Club, CRISPR Therapeutics, Jumia, continuing to add to those, like those. And I've got a pretty sizable cash position. It's now under 10% a little bit. But I think today was a good day. And I think unless something really materializes this quarter, which is possible, but I don't see it yet, especially because Ford and GM, companies that in past recessions have been very susceptible to problems, didn't express fear, and rates have already risen. So you would think that they would see something already if rates are rising. Leads me to be optimistic that this quarter isn't going to be crazy bad. It's not going to be bad, even possibly. It might just be flat. And flat is probably good given how the market's reacting. So overall, I have to adjust to being a little bit more bullish. And that's what this week's been about. We took the puts off Monday. We've slowly been rotating more bullish. I do want to hear what Apple has to say. I'm not saying this is all like gung-ho, like we're going up. But I think sideways is now more likely than down. Maybe the lows are in. Maybe this is kind of the low end of a range. Who knows? We'll see. We'll hear what the technical analysts say about that. But I think things are sideways. I think they're not down. I think the downside is it's just hard. If the Fed is going to be less hawkish, that's the big thing. Ford and GM still optimistic. Those are, people go to used cars and auto parts when things get tight, and we're not seeing things get tight. We're seeing lots of iPhones be upgraded, and it's like not like these are the people who were super hype at the release and bought it right then. These are, my assumption is, I'm no Apple data scientist, but people who just chose to buy an iPhone and aren't hardcore fans who need to get the next thing. They just said, it's time. It's time. They could have waited. If things were really tight, they would have waited, but they're not doing that. Ford, GM saying they're not doing that. I'm not really hearing a whole lot about that. And if rates are going to be capped out, that's a good thing. If I'm not saying GDP going down is a good thing, but it affects what the Fed can do with rates. And look, I was a big bond shorter, so I've had to pivot that a little bit. I've had to temper my expectations with that a little bit. Just got to adjust to the facts. And I think that's going to help us go sideways. We've got some positive, some negative forces, and I think they're all just going to leave a sideways market. The highs, we don't want to get back to those market highs, okay? Those were very high highs. Shopify, down at 20 PE. All right, that's starting to look reasonable. Netflix, 20 PE. All right, that's starting to look reasonable. These are actually palatable stocks. And we want things to be palatable. We don't want things to be not palatable and excessive retail just buying brand names they know. That is when problems arise, and that's when pain gets seen. And we've seen the pain. Hopefully, we have, in fact, seen the pain, and now things can go sideways. Sideways is good, in my opinion. So, we'll see what happens. We're going to listen to that Apple call. What's up with China? Maybe they mention it. We'll see. But that's today's video, and until next time, peace out.